Before you trade options in 2026, there's one thing you absolutely must understand: the Greeks. They determine how your trade behaves, how much risk you're taking, and why your P&L moves the way it does. Delta measures how much your option changes when the stock moves. A 50 delta call acts like owning 50 shares, and it also represents roughly a 50% chance of finishing in the money. Theta is time decay. Buyers lose theta every single day, sellers collect it. With short-term expirations becoming more popular, theta will have an even bigger impact on traders in 2026. Vega measures your sensitivity to implied volatility. When volatility spikes due to earnings or major news, options increase in value. When volatility collapses, options deflate. With 2026 expected to be highly event-driven, Vega will be one of the most important Greeks to understand. Gamma measures how quickly your delta changes. As expiration approaches, gamma rises sharply, which is why short-dated options can swing wildly. High gamma creates fast profits, but also fast losses. To summarize, delta is direction, theta is time decay, vega is volatility, and gamma is the speed of change. These four Greeks explain most of how options behave. Use them wisely in 2026. Thanks for joining us at optionstrading.org.